Just days ago, Tencent's market capitalization fell below 4 trillion Hong Kong dollars, and soon after, Alibaba's dropped below 2 Hong Kong dollars trillion. The Hang Seng Index and the Hang Seng Tech Index appear to have entered a technical bear market at the same time. Zhipu's market cap once again surged past 1 trillion Hong Kong dollars, and Biren Technology hit an all-time high of 165 Hong Kong dollars billion. In the A-share market, Cambricon came within a hair's breadth of breaking through the 1 trillion yuan mark, while the Chinext and Star Market boards continued to widen their performance gap against the broader market. It is abundantly clear that the Greater China capital market now favors only one type of asset, anything directly tied to AI. That if we loosen the definition a little, embodied AI can also be included. To be more precise, hard tech assets centered on AI are the only assets for which Greater China investors are willing to pay a premium. Moreover, such assets must be pure, tainted as little as possible by other factors. Among China's internet giants, Alibaba, Baidu, and Kuaishou all have sizable AI operations, yet their stock prices have gone nowhere over the past month. Even frequent announcements by management about new AI breakthroughs have done nothing to help. What exactly is the problem? Have mainstream investors lost their minds and abandoned rationality? I believe the core issue lies in economic uncertainty, particularly the uncertainty around domestic consumption. This brings us to a critical difference between the U.S. and China tech bull markets. Over the past 3 years, U.S. domestic consumption has generally been robust. Even as CPI repeatedly ran hot, consumer spending remained resilient. The tech sector and traditional consumption advanced together like twin engines. Tech by a huge leap, traditional consumption by a smaller, yet still solid, step. During that same period, China's main economic driver was exports, while domestic consumption stayed lukewarm. Online consumption often outperformed offline consumption, but there was no fundamental difference. Investors had no choice but to focus their attention almost exclusively on the narrow AI-centric tech track that in this AI bull market. America's largest retailer, Walmart, saw its market cap triple and briefly crossed the $1 trillion threshold. Costco more than doubled from its trough. Even though it has traded sideways for the past year, Amazon's market cap rise has mainly been driven by its cloud business. But its North American e-commerce operations have also performed exceptionally well, serving as the ballast for its earnings. Many consumer brand companies have likewise delivered excellent results and market cap growth. Too many to list here. But their performance has simply been overshadowed by the dazzling glare of the tech sector. It is easy to notice that over the past year or so, several reversals in the U.S. stock market have been tied to expectations around domestic consumption. In May last year, under the shadow of the tariff war, the AI bull run was once in danger of ending. But in July, the signed and enacted OBBBA provided massive tax rebates and subsidies to consumers, propelling the capital market rapidly to new highs. In March this year, the Persian Gulf crisis sent oil prices soaring, dealing another heavy blow to U.S. tech stocks. Yet the moment the scope of the conflict was contained and CPI stabilized, the bull market returned. As for the pullback from the peak that U.S. stocks have experienced over the past 2 weeks, it is inseparable from the slowdown in consumer spending growth and the decline in consumer confidence indices. In short, without strong domestic consumption, the U.S. AI bull market would be unsustainable. As for whether that domestic consumption is genuinely real, whether it has been front-loaded, or whether it is simply the result of the Fed printing money. I will refrain from commenting. The fact remains that they have the ability to make the numbers look good and to convince investors. So the value of core assets has been able to hit new highs again and again to in the first half of 2025. A similar scenario actually appeared in the Greater China market. Everyone should still remember the stellar performance of new consumption standard bearers like PopMart, Laopu Gold, and Meituan Bingxing.in. Fact, throughout 2025, Hong Kong's tech and consumer sectors showed a strong rotational trend. Tech performed very well around the Spring Festival and at the end of the third quarter, while consumer sectors shone in the second and third quarters. This is a common and healthy dynamic that reflects optimistic economic expectations. Entering 2026, everything changed. Tech became the only hot track, and within the tech track, a violent divergence occurred. Only emerging, so-called pure-blood tech companies that have zero connection to the traditional economy can win the favor of the capital market. Looking at Zhipu at a trillion yuan valuation, Cambricon nearing a trillion yuan, and Montage Technology at 500 billion yuan, many value investors must be puzzled. Why not buy Alibaba or Baidu? Both have formidable in-house chip development businesses and have plans to spin them off and list them. The scope of their deployment likely surpasses that of any listed domestic chip company. Why not buy Kuaishou? Its video large model is very powerful, and it also has plans for independent fundraising. Why not even buy Meituan? It has its own proprietary large model and has invested in numerous AI startups. And even setting aside the lack of buying, why are the companies mentioned above, along with Tencent, which is actively increasing its AI investments, falling instead? Why does the market show zero interest in their AI business progress and refuse to assign any valuation to it? I believe the answer to these questions is not that the capital market has become schizophrenic. Rather, the capital market is voting with its feet, loud and clear. It is unwilling to bet on the uncertainty of domestic consumption and will only invest in hard tech that is completely decoupled from consumption. Tencent, Alibaba, Baidu, Kuaishou, and Meituan are, at their core, still consumer internet companies. The bulk of their business is tied to domestic consumption. Buying such a company is equivalent to buying a large chunk of consumer business, which the market currently shuns, plus a small slice of AI tech business, which the market dearly loves. So how exactly are you supposed to value it? In an optimistic market where mainstream investors have very long evaluation horizons, people would of course be happy to value such a company, perhaps even viewing it as a superb long-term arbitrage opportunity, getting a cash cow business and a high-growth business at the same time, at a huge discount. But the current Greater China capital market is nothing like that. Mainstream investors are restless, future visibility is very poor, and performance evaluation horizons are extremely short, rather than gambling on a value re-rating for structurally complex internet giants. They would much rather chase those pure-blood tech companies that have already run up a lot, but possess high growth certainty in the United States. During the early and middle stages of the AI bull market, Google and Amazon each experienced similar skepticism and undervaluation. Later, Google broke out of it through its Gemini large model and the development of its TPUs, and Amazon did the same through a far more aggressive GPU cloud platform strategy. However, the crux of the matter was that their core businesses, consumer internet, performed very well. Even when Gemini was under the heaviest skepticism, Google's advertising business maintained double-digit growth. Even when AWS growth was far behind Azure's, Amazon's North American e-commerce business grew nicely, and its international e-commerce business achieved stable profitability. Without the steady growth of their core operations, these two tech giants could never have hit record highs, and that steady growth, in turn, was built on the foundation of strong domestic consumption. Robust domestic consumption not only allowed Silicon Valley's tech giants to deliver good quarterly earnings, but also gave them healthy operating cash flow, enabling them to sustain enormous AI capital expenditure plans. This is the perfect embodiment of consumer spending sets the stage, and tech performs on it. A large portion of the dollars spent by U.S. consumers and advertisers was funneled directly into GPUs, CPUs, and memory chips, propelling the AI bull market from one peak to another. Who wouldn't love an asset that can offer high growth guidance while also maintaining large-scale buybacks and dividends? If the U.S. AI bull market is to end, the trigger will likely not be AI being debunked. That is impossible to debunk. Anyone who still thinks AI is a bubble today should be sent back to kindergarten. Nor will it be the argument that capital expenditure is unsustainably high. That tune has been sung before and is not very convincing. Instead, it would be a serious problem in the U.S. economy, particularly in domestic consumption. When domestic demand is well managed, the overall vitality of the economy is high. Every lash of the whip on emerging industries leaves a clear mark, and every slap draws blood. The results come fast, and with less effort. The capital market automatically enters a state of high confidence, needing no encouragement at all. Therefore, we absolutely must make domestic consumption strong.